Welcome back to Tesla Daily News Podcast. It's Friday, March 27th, 2026. Today, we're tracking the three big forces that can move Tesla fast: macro risk from the Middle East and oil, fresh competition signals in EVs, and the next wave of Tesla-adjacent bets: robotics, robots, and chips. Story 1. Oil is back in charge of the tape, and Tesla is getting dragged with risk assets. Context: when crude spikes, markets reprice inflation, rates, and consumer demand all at once. Bad for high-multiple growth stocks. Details: global stocks and bonds slid as ceasefire hopes faded in the Iran conflict. Brent jumped roughly 3.8% to above $106 a barrel, with talk of extreme scenarios as high as $200 a barrel. In pre-market, Tesla was down about 1% alongside the Magnificent Seven. Impact: higher oil can help EV demand at the margin, but in the short run it's usually risk-off: higher yields, tighter financial conditions, and multiple compression. That tends to pressure Tesla regardless of EV narrative. Takeaway: watch crude and the 2-year Treasury yield more than any single Tesla headline today. If oil stays elevated, expect volatility and sensitivity to rate expectations. Story 2. Honda and Sony just pulled the plug on Afeela, another sign the EV field is consolidating around winners. Context: EV development is capital-intensive, and demand softness plus policy rollbacks are forcing tough decisions. Details: Sony Honda Mobility said it's halting development of its Afeela EVs after Honda scaled back EV ambitions and took a write-down of up to roughly $15.7 billion. Afeela deliveries in California had been expected late this year, with the second model targeted as early as 2028. The Afeela One price had started around $89,900, and the JV said it would issue full refunds to reservation holders. Impact: for Tesla, fewer credible entrants in premium EVs is a competitive positive, less pricing pressure at the high end and fewer story stocks siphoning attention. But it also highlights how tough the market is right now, reinforcing that scale, software, and manufacturing efficiency are the moat. Takeaway: EV competition isn't just about new launches, it's about who can fund losses long enough to reach scale. This exit is a small but clear win for incumbents like Tesla. Story 3. BYD's Europe push is accelerating, and it's a real valuation input for Tesla. Context: Tesla's biggest strategic challenge remains Chinese OEM cost curves and rapid model cycles. Details: reporting out of Bulgaria describes BYD entering the market aggressively, citing 2025 sales of about 4.6 million electrified vehicles and around 2.3 million battery electric vehicles. The article also highlights fast-charging claims, including sub-10-minute charging under certain conditions, and a broad product lineup with aggressive pricing and dealer expansion. Impact: whether every figure holds up in each market, the direction is clear. Chinese OEMs are exporting scale and are willing to compete on price, features, and charging narratives. That pressures Tesla's margins and forces continued efficiency gains and product refresh discipline. Takeaway: for Tesla holders, BYD's European traction matters because it attacks Tesla's growth premium. The key question is not headlines, it's whether Tesla can maintain volume growth without sacrificing automotive gross margin. Story 4. California regulators say Tesla's Robotaxis are treated like a limo service, important for timeline and narrative risk. Context: autonomy is a core pillar in Tesla's long-term valuation. Regulation determines how quickly autonomy can monetize. Details: a California Public Utilities Commission official said Tesla does not have the permit required to operate a true autonomous robotaxi service in the state. Instead, Tesla operates under a charter party carrier permit, like a limousine company, because Tesla's system is considered SAE Level 2, not Level 3 or Level 4. That also means Tesla doesn't have to submit the same operational safety and performance data that services like Waymo and Zoox submit. Impact: this cuts two ways. Less reporting can reduce near-term regulatory friction, but the classification is a reminder that California does not view Tesla's current stack as autonomous ride-hailing. If investors are pricing fast robotaxi revenue, this is a reality check. Takeaway: the autonomy story is still alive, but regulatory definitions matter. Watch for any move by Tesla to pursue higher-level permits, or for the DMV advertising disputes to escalate. Story 5. Tesla and SpaceX Terafab chip manufacturing, huge ambition, huge capital, and a real execution risk. Context: Tesla wants more control of compute for full self-driving, Optimus robotics, and AI workloads. Chips are the choke point. Details: multiple reports cite Musk's plan for 2 semiconductor fabs in Austin, Texas, aimed at supplying Tesla, xAI, and SpaceX. Business reporting notes Tesla is already hiring Terafab engineers, including lithography-focused roles. Listed base pay ranges were roughly $88,000 up to about $240,000 for some roles, and up to about $338,000 for certain integration engineering roles. External estimates put a Terafab scale effort in the $20 to $25 billion cost range. Impact. Strategically, vertical integration can protect Tesla from geopolitical and supply constraints and can improve iteration speed. Financially, it's capital-heavy and could compete with other priorities: new vehicle programs, battery scaling, and autonomy compute. The stock question is whether this becomes a high-return moat or a cash sink. Takeaway: treat Terafab as a long-dated call option. Investors should track capex guidance, partner commitments, and whether Tesla can keep core automotive free cash flow resilient while building it. Story 6. Robotics is moving from hype to visibility, and Tesla's Optimus is now part of mainstream competitive framing. Context. Tesla is positioning Optimus as a future revenue engine, but competition is intense. Details. A humanoid robot from Figure AI, Figure 03, appeared at a White House technology and education event and is described as competing with Tesla and Boston Dynamics. Figure AI says its manufacturing facility is designed to produce up to 12,000 humanoids per year, targeting 100,000 units over 4 years. Impact. For Tesla, the good news is validation. Humanoid robotics is becoming a policy and consumer conversation. The bad news is that it reduces Tesla's uniqueness premium if rivals scale first or if Tesla's timelines slip. Takeaway. Optimus remains a key upside lever for Tesla, but investors should benchmark Tesla against real production targets and unit economics, not demo videos. Quick wrap. What this means for Tesla today. The near-term driver is macro. Oil up, yields up, stocks down, Tesla trades with that risk basket. On fundamentals, consolidation like Honda Sony's Afeela cancellation is a modest competitive positive, while BYD's expanding footprint is the bigger structural pressure on Tesla's margins and growth premium. On the long-duration story, regulators in California are signaling Tesla's Robotaxi branding is ahead of its legal classification, while Terafab and Optimus reinforce the company's push into compute and robotics, with high upside and real execution risk. That's it for today's Tesla Daily News podcast. For tomorrow, keep an eye on crude prices and any new regulatory updates on autonomy permits, plus more details if Tesla clarifies capex or hiring scale tied to Terafab. If you found this useful, subscribe and follow for your daily Tesla investor briefing.